Hello, traders. Gary Wagner here. It is Friday, finally, approximately a quarter to 12 in Honolulu, making it a quarter to 6 in New York. And this is the daily report for Friday, the 23rd day of March, our weekend review. And oh, what a week we witnessed in the metals markets. We had a continuation at the beginning of the week of this correction, this corrective phase. And what I find very, very interesting is that although it was initially my belief that we had concluded the correction, this is last week, we bought our first position long gold at 1658. As it declined and we charted a support level, and that major support level is the 61% retracement of the entire rally. We'll talk about that in detail today. We went ahead and issued another buy trigger yesterday, bought at around 42, putting our net average position now at 1650 per ounce. Market today closed up $17 at 1663.80, 1662.80. That is Kitco's numbers, and as you can see, 1661.39 is my current print for the cash market in gold. As far as silver, we had a dynamic performance in that today also, up about 65 cents, up approximately 2% on the day to close at 32.34. 32.24 bid-ask spread, according to Kitco. We'll talk about that in detail towards the end of the show when we cover silver specifically. Now, before we get started looking at gold and silver in detail, wanted to very, very quickly look at a couple of markets that absolutely affect the precious metals markets. First of all, primarily the dollar index. This is a weekly chart. It's a box chart that indicates each box with a higher close compared to the open on Monday in green and lower in red, similar to a candlestick, although there are no wicks. You can see for the last 2 weeks on a weekly basis, we have had lower prices in the dollar index. Also realize that when we look at the dollar index, that we are looking at a marketplace that has, quite frankly, come very, very strongly off of these highs that we saw back in 2009, beginning of 2010. The Standard & Poor's 500, the equities market, you can see that we were raging. These are these recent highs that we had, toppling over 1,400, and that of course corresponds to a Dow going over 13,000. You can also see quite clearly that we have this pivot point, these particular indicators that we look for in the equity, or in a Henkin chart that we're witnessing in the equities markets, these smaller bodied candles right in here, and the change from green to red, and that of course is on a daily chart. Traders, realize that as new data becomes available, my primary function as an analyst for you, my subscriber base, is to be 100% honest with my analytical take and my analysis of that take. In other words, if new data suggests that my underlying assumption might in fact be incorrect, I have to be able to react quickly, succinctly, and turn the new data into a positive factor that can make profits for us as investors in the precious metals markets. And that's exactly what happened to us this week. When you consider the following, first of all, this is a 360-minute Henkin chart. When we look at this chart, as you can see, my original plotting of this marketplace itself was an A, our B, and then our C. My belief was that we had concluded our corrective stage, gone into wave primary 3 of an intermediate wave, and we were headed off to the races. I could not have been more incorrect, because in essence what we really saw was a continuation of this wave 2. If we look at our intermediate count, we have wave 1 here. This is now going to be wave 2 here, and I'm fairly certain that that should hold. But here's what I found, and that is that we had, as this market moved up, I'm now labeling this D and E, in a traditional, what's called a triangle correction. It is traditionally not in a downslope like this. Traditionally what you get is a consolidation or a pennant formation in which you get A, B, C, D, and then E, all within that, and then you'll get your breakout. If the underlying trend, of course, is up, the breakout's to the upside or to the downside. It will typically go to the prevalent direction of the trend. However, in this case, we're looking at a live market, and what we noticed was that it wasn't really following the particular game plan that we believed it would. And so, therefore, what we have to really do is act accordingly. So, when we take a look, we did have our A, our B, and then our C. We entered a long trade right in this area, about 58, and the market continued to trail lower. However, what I believed was that we should have primary support at this 16, call it 24 level. And so when the market came down, it actually tested 28 right in this area. In fact, I did get quite a few emails that asked if it was safe to go in the water, and this was when the market was trading at around 1630, 1631. I said it was high risk, but I believed that those lows would hold. What we did is we dollar cost average. In other words, we added one position right in this area, call it 642. Our average price now is at $16.50. So when we had this $17 move, of course, the beauty of that is we've got some sizable profits as we go into the weekend's trade. Now, I am covering these charts in greater detail in a commentary that went live with Kitco this morning. I did email all of my subscribers out a hard copy of that yesterday. There can be no doubt we had a really interesting week in the market. A couple of charts that we'll look at very, very quickly, both in Henkin format. This is a 60-minute chart, Japanese average format. The interest that I have in the chart, of course, is this really strong V-bottom, this reversal that we got. We did point that out to our daily subscribers yesterday. This was one of the indicating factors that really caused me to initiate that dollar cost average buy. And realize, traders, to me that is a very tricky procedure, because we are going in and adding to a position which is not profitable. Counterculture. However, as long as the market stays within a certain set of parameters, in other words, if we believe there's hard support down at 1620, 1625, the market breaks below 1630 and bounces off and starts to move back up, it gives us technical confirmation that that assumption has a high probability of being correct. That's the point we want to take advantage of those types of situations. You can see that this market pretty much came straight off, small little correction, straight off, and then hit these highs at around 1666 and closed right at 1661. You can really see it on these very short-term 60-minute charts. Now, when we go and look at our daily chart, realize these are lagging indicators. Henkin charts are moving average charts. They are based upon a relationship between the midpoint of the prior candle on a daily chart, the prior day, and how it compares to today's trading activity. We have gotten our first real indication today that there's possibly a buy in gold. And look, the market's already at 61. If it continues to rise, that buy signal will reach us at about 1670. So I believe that we've got a really strong entry-level position and a good opportunity if we truly go into this impulse period and wave where we can see some dynamic profits to the degree that we saw on our first trade of the year. And our first trade of the year, we're in at 1580, out at 1700. It's a beautiful trade. Finally, the silver market. Looking at a daily Henkin chart of cash silver. And as you can see on our Henkin charts, it's an average chart. Even with this dynamic close, we still have no indication that we're in buy mode. However, that will change fairly quickly when we remove that and simply look at a candlestick chart. Because within a candlestick chart, we have a pattern simply called an engulfing bullish right in here. And an engulfing bullish is a signal that must be accompanied with a confirming candle. Now, a confirming candle is going to be that on Sunday, to me, Monday's trading activity in Australia, you get this market where you have another green candle, another green day, meaning it opens and closes higher with a higher high and a higher low. If we get that, that's going to signal a trigger or a buy trigger, and we will enter our silver trade. Realize that when the markets were moving against us through this week, I was reluctant to add and initiate a silver position because I hadn't seen any concrete evidence that the gold position was working for us. So traders, we're going to be looking at this Sunday and Monday. We should put out a special trade or buy alert in silver. And traders, for the last chart of this version of our weekend review, I want to look at a weekly chart of silver. And the reason for pulling this chart up is to just look at our retracement point. This retracement starts at the beginning of 2011. You've got silver around $26. Trades up almost to 50, and then you get a series of corrections. You get this first correction, 61% correction of that move. Market then comes and cannot make a new higher top and kind of fades out right at that 38% level, comes down and retests these lows, a series of lower highs, retests it for a third time, and then when it comes up, it cannot get past this 50% level right in here. But as you get this retracement, you can see it comes to a 76% retracement of this last big rally. It's also a 50% retracement of a smaller base rally, meaning if we simply look at the price move right in here to here, this point right here is 50%. So you get that Fibonacci harmonics. Those two factors are really indicative to me of a market that's probably going to hold some really, really strong support. So as I said, we'll look to enter on the long side Monday or Tuesday. Traders, have a great weekend. This has been Gary Wagner wishing you, as always, good trading. And we'll talk to you on Monday for another daily review and update. Bye-bye.